All right, let's talk about IFRS 2 on share-based payments. If you're studying for your accounting exams, you know this one can feel like a bit of a maze, but trust me, it's not as scary as it looks. We're going to break down the core ideas piece by piece so you can walk into that exam feeling confident. Let's jump in. So let's start with the most basic question of all. Why even bother with this? Companies have cash, right? Paying people in shares just seems complicated. But there's a really powerful strategic reason behind it, and it changes everything about how employees view their work. And here's the answer. It's all about one word: alignment. See, when you give an employee shares, they're not just an employee anymore. They're an owner. Suddenly, making the company more successful means they become more successful. It's a powerful way to get everyone rowing in the same direction. Okay, so for the accounting, IFRS 2 splits the entire world of these plans into two big categories. Seriously, every single share plan you'll ever encounter in an exam question will fall into one of these two buckets. It's either equity settled or cash settled. Nailing this distinction is the key to unlocking everything else. So, what's the actual difference? It really comes down to what the company owes. This goes right back to the IFRS conceptual framework. With an equity-settled plan, the company promises to give its own shares, which is an equity instrument. But in a cash-settled plan, it promises to pay cash. The amount of cash might be linked to the share price, but the obligation itself is to hand over cash. And that, my friends, creates a liability. That's the critical difference. Okay, so we know the two types. Now for the fun part, right? How do we actually account for them? This is where we get into the nitty-gritty, the rules of the game, and this is where the two types of plans start to go down very, very different paths. First up, equity settled. As the name says, the company's going to settle its obligation by issuing its own stock, giving employees a piece of the ownership pie. Now, this is important. Because it's settled in equity, we don't create a liability. Instead, we'll build up an equity reserve over time. And here is the golden rule for equity-settled plans. Burn this into your memory for the exam. We measure the total expense using the fair value of the options on the grant date. That's the day the promise is made. And once you calculate that number, it's locked in. It never, ever changes, even if the share price goes to the moon. This gives you certainty and predictability in your numbers. Now let's flip the coin to cash-settled payments. Here, the company owes cold, hard cash. The share price is just being used to figure out how much cash. And because the fundamental promise is to pay cash, we have to recognize a liability on the balance sheet. It's just like any other bill you have to pay. And this, of course, leads to a totally different golden rule. For cash-settled plans, that liability has to be remeasured to its fair value at every single reporting date until it's finally paid. Just think about what that means for a second. The share price goes up, your liability and your expense go up. The share price goes down, they go down. This introduces a ton of volatility into your financial statements. Okay, let's just pull this all together. This slide is your perfect revision summary. Equity settled. Measure it once at the grant date, it creates an equity reserve, and the expense is smooth and predictable. Cash settled, you have to remeasure it constantly, it creates a liability, and it can make your profits jump all over the place. Got it? Good. All right, you knew it couldn't be that simple, didn't you? Of course not. Companies don't just hand out shares for nothing. There are almost always some, let's call them strings attached. In the world of IFRS 2, we call these vesting conditions. This is exactly the kind of question that moves you to the next level of understanding. What if an employee has to stick around for 3 years to get their shares? Or what if the share price itself has to hit a specific target? These conditions really change how we do the accounting. So IFRS 2 splits these conditions into two very distinct categories. You have market conditions, which are tied to the share price, like hitting a $50 target. Then you have non-market conditions, which is basically everything else. Usually it's a service condition, like staying for 3 years. The accounting is totally different. For a market condition, the probability of hitting it is already baked into the fair value on grant date. You never touch it again. But for non-market conditions, you have to estimate each year how many people you think will actually meet the condition and adjust your expense accordingly. Okay, time for the final piece of the puzzle. What on earth happens when a plan gives either the company or the employee the choice to settle in shares or cash? Yep, these hybrid plans have their own special set of rules. The accounting for these complex plans all comes down to this one question. Who has the power? Who's in the driver's seat? The answer to that question will tell you whether you're looking at equity, a liability, or maybe even a mix of both. Look, here's how you tackle this. It's a simple two-step process. Step 1. Who has the choice? If it's the company, you treat it as equity settled, unless they have a habit of paying cash anyway. But if the employee has the choice, you've got what's called a compound financial instrument. You have to split it into two parts. You figure out the liability part first, and whatever is left over is the equity part. Step 2 is just applying the rules we've already learned to each of those pieces.
Phew! Okay, we've been deep in the technical details. Let's zoom out for a second. Why does all this matter? Why do you need to know this? Because these accounting choices have a massive impact on how a company's performance looks to the outside world.
Deciding between an equity settled or a cash settled plan is a huge strategic decision. It directly hits your reported profit. It decides whether you've got a growing liability on your balance sheet. It messes with all your key equity metrics. If you understand these rules, you understand a powerful tool management has to shape their financial story. So I'm going to leave you with a final question to chew on. Put yourself in the CFO's shoes. You want stable, predictable earnings, right? So which scheme creates more risk and volatility for your company? The cash-settled plan, where the expense can swing wildly with the stock market, or the equity-settled plan, where the cost is locked in on day one? Think that through. It'll really cement your understanding. You're doing great. Keep practicing, and I'll see you next time.